It's that time of month again. Get your tissues ready. Some of you are going to be crying by the end of this video based on where your favorite income ETF was ranked on this month's Power Rankings. Power Rankings are a method used to evaluate and rank ETFs based on their performance, potential, and overall strength. But one key metric, as with anything in life, it's what have you done for me lately? These put extra emphasis on recent performance, not what have you always done for me. I also take into account what people are saying in the comments. So the more I hear you mention an ETF in the comments below, the more I'm likely to put it higher in the rankings. I often do not have time to research the hundreds of income ETFs out there, so I rely on you guys to share this valuable info with me. My last Power Rankings video came out on August 31st, so extra emphasis will be put on the performance of the ETF since that date. Number 11, ESOL, Simplify. ESOL went down almost 4% since the last time I made this video. Now, with ESOL, we've had some price depreciation, unfortunately. It's also lowered the dividend by 2 cents. This has to do with the overall federal interest rate going down. ESOL holds a lot of those treasuries, so that's why the dividend went down. They still boast a very impressive 16% yield, and that should be sustainable. It's supported by expected market growth, and it should also have some great options trade profits from these rate cuts. So ESOL once again shorts the VIX position, then has a VIX call option for protection. It has a 5-star rating from Morningstar as an ETF. It's actively managed, of course. ESOL is taking a little bit of a slide, but that's because there's so many great income ETF products out there. Number 10, YMAX, NVIDIA. YieldMax was down 85 basis points since the last time I made this video, and NVIDIA was up 91 basis points. YieldMax. Honestly, I just keep YieldMax on this list just so I can make a good dig at the high yield dividend warriors. We know many people in our personal lives with TDS. I won't go over what that stands for, but you know there's going to be people with TDS in your day-to-day lives. But there's also many in our community that have HIDS, or high yield derangement syndrome. And you really need to get yourself checked out, because being in the comment section of some of my videos, being on the Reddit forums, being on the Discords, the level of stupidity with the high yield dividend warriors is continuing to multiply. We have many of these high yield dividend warriors thinking that they are going to be buying Cybertrucks and get $650,000 in passive income a year, every single year, from a $90,000 portfolio, all on margin. Honestly, go get tested for HYDS, you high yield dividend warriors. Some of these warriors' brains, they need to be studied, because there's no way humans can be this dumb. Honestly, if you're dumb enough to give somebody all your money, you kind of deserve to get ripped off. But that's not to say that not all YieldMax products are bad. For example, YMAX, NVIDIA, they've still held up pretty well. There's other YieldMax products that have done well, so I do want to give them that credit. It's just too much fun to make fun of the high yield dividend warriors. Number 9, SPYT Defiance. All right, this is the debut on these rankings. It's making its debut because it had a lot of cheerleaders in the comments of my prior videos. That's the only thing that's really holding this up, because if it were up to me, I would have never ranked them so high. I haven't been overly impressed with most of Defiance's products. I didn't think I'd be that optimistic about SPYT, but after looking at its history, it's done pretty decent so far. See, it holds shares of the S&P 500 via various ETFs, and then does daily credit spreads, hoping to target around 20% of annual income. It's great to target 20% annual income, but that doesn't necessarily mean you're going to get 20% annual income every single year. I mean, I can tell you I'm targeting 100% annual yield of income every single year. That doesn't necessarily mean I'm going to get it. SPYT has only been around since March, and so far has not had much of the dreaded word that we hate to say, NAV erosion. That really hasn't happened so far, and they've consistently paid around a 33-cent dividend since inception. A real market downturn and recovery, that will be the true test for this fund, as with a lot of the newer funds that we're going to talk about in this video. Number 8, Bali, BlackRock. This ETF was down 23 basis points since the last time I made this video. Oh man, there was no other ETF mentioned more in my comments last month than Bali. Talk about Bali, Cody. You forgot about Bali. Guys, Bali was on this list before. It just wasn't doing that hot. But man, you guys wanted it, so I put it on the list. Bali has their own stock selection process. It's based on data, rich data. And of course, they're gonna get us monthly income by selling call options. And there's some chance at potential upside and lower volatility with Bali. It's just the best of all worlds. Bali just celebrated its first birthday. It's up 22% while claiming a 7% yield. That's quite impressive. I might just have to rank Bali a little higher if they keep this up. Let me know in the comments if they should be higher or not. Number 7, TDVI, the SIBO Vest Technology Dividend Target Income ETF. I need to shout out Meg Kaham, or however you pronounce it, because he or she, or maybe they're a they consistently for months told me about this fund, but I just would not listen. But finally, I was educated on how great this ETF. They are doing an option strategy consisting of selling U.S. exchange-traded call options on the NASDAQ 100 or the S&P 500 index. They have an expense ratio of 75 basis points. That's not exactly cheap. There's going to be cheaper ETFs on this list. The fund launched in August of 23, but has been up 28% since inception. That gives us around a 7% yield, just like Bali. They have a super low assets under management of just $39 million. That means a lot of people really don't know about this fund. But every moment that you hesitate could be a missed opportunity to build on your future. Investing in yourself, your skills, or your possessions can open doors to wealth and fulfillment. Choose growth over comfort. Each small step that we take today can lead to financial freedom tomorrow. Don't let the fear of failure hold you back. Embrace the journey and watch your potential unfold. You know, I was a little bit mad that the ETF missed on the wonderful opportunity of just using the ticker that would have been TDIV, but then I learned that that ticker is already in use by another fund. Now it's up to you to determine if the 7% yield with some upside is worth it. Others might want to take on more risk, and that's where number 6 comes into play. Number 6, XDTE, QDTE, Roundhill. XDTE was up 6 basis points since the last time this video was made, and QDTE was up 66 basis points. All right, this is the very popular fan favorite, and I've made a ton of videos on this weekly pair, especially recently. I've explained why getting paid weekly versus monthly makes next to no difference from a cow pounding perspective. I've explained that their strategy does come with a lot of risk, and who would have thought getting 30 to 40% yield comes with risk. Now, I really enjoy duking it out with the high yield dividend warriors in the comments. My favorite is me showing them evidence of NAV erosion and then them pretending it doesn't exist. Or when they can't answer the basic question of how is this fund sustainable if it requires you to constantly reinvest the dividends, bro? How are you going to be living off the dividends, bro? High yield dividend warriors, do I have a great investment for you? I have some volcano insurance to sell to these nimrods. Enjoy this weekly pair and all the upside you're getting right now while it lasts, high yield dividend warriors. I want you guys to prove me wrong. Prove me wrong. Number 5, JPXQ, JP Morgan Chase. JPY was up 27 basis points and JPXQ was up 83 basis points since the last time this video was made. Now, I could talk about how JP Morgan Chase just had an excellent surprise earnings report, but instead, I will talk about how JPY's dividend is rapidly climbing back up after dividends as low as 28 cents, the dividends are back up into the high 30s in back-to-back months. JPIQ is also doing great, back-to-back 55-cent dividend months, but with low expense ratios, and both of these funds have billions of dollars in assets under management. JPXQ is going to consistently rank high in these power rankings. These two ETFs have consistently given higher returns than REITs, than treasuries, and other equities. It's a no-brainer why so many people want exposure to this particular income ETF in their portfolio as they're on their journey to retiring or living off dividends. The only thing better than JPY and JPIQ would be getting access to infinite money glitches. Number 4, SPY, QQQI, NEOS. Now these two funds utilize a call option strategy that may include both sold and purchased NDX index options, which may provide the opportunity for upside capture in rising equity markets. Of course, the index is going to vary based on the ETF. But QQI dividend, it actually went down by 4 cents, but still a very consistent dividend, around 60 cents every single month since their inception. And it's the same story with SPY. The dividend was down 4 cents, but again, the dividend has consistently been around that 50-cent mark every single month. That's just under a 1% yield every single month. That is a surefire way to build wealth and become rich. If I'm going to be retired and living off my dividends, I want a fund that is consistent because my bills are still going to exist at the end of every month. I need my dividends to also exist as well. Number 3, Fappy, AI Pi, REC shares. Fappy was up 87 basis points and AI Pi was up 3.91% since the last time this video was made. Now, welcome back to the podium, Fappy. Fappy has previously been ranked as high as number 1 on these income ETF power rankings, but some NAV erosion and lower dividends had them free falling last month. But Fappy does what Fappy does best. They pay fat dividends. Fappy just celebrated its first birthday. What's up with all these birthdays in October? And has given out a 25% yield. That is an amazing return. Let's hope it can continue this in year 2. Fappy is about flat all time, but I will gladly take the flatness if I can get a big, juicy 25% yield with my income ETFs. That's an easy way to become a millionaire. But keep in mind, we've basically only had good times in the stock market since Fappy's been out. There was maybe some small hiccups, but generally we've just hit 2 years of a strong bull market. That won't always last. REC Shares has another less known income ETF product out there called AI Pi, focuses mainly on AI technology, and that's only been around for 3 months, but it's consistently paid out the same dividend of $1.48, which is on pace for a 35% yield so far. So they have only had minimal NAV erosion, but have had some juicy dividends. Let's hope they can keep it up. Number 2, iSpy, IQQQ. iSpy was up 27 basis points. IQQQ was up 19 basis points. These ETFs are powered by daily call options strategy. It's giving high income potential by selling call options each day that can produce a high level of income. Now, these funds paid a ridiculously high dividend in the month of September, so I'm not going to penalize them for coming back down to life with a more reasonable dividend this month, which was 34 cents for iSpy and 32 cents for IQQQ. Now, iSpy's 12-month yield of 9.13% is actually just under IQQQ's 9.29%, which is surprising. Usually the NASDAQ 100 is more volatile, thus higher premiums/dividends. Both of these funds have had a little bit of capital appreciation so far, so thankfully no NAV erosion. Now, before I get into number 1, I just want to highlight how amazing it is to have so many great investment products out there for us to grow our wealth together. And of course, we're going to disagree on which one might be the best, but it's just so amazing that we have access to so many great products. We have a choice to dictate where we put our hard-earned money to get even more money. Number 1, GPIX GPIQ, Goldman Sachs. GPIX was up 35 basis points and GPIQ was up 78 basis points since the last time this video was made. Yet again, nobody can stop this Goldman Sachs juggernaut. GPIQ is up 24% all time. They will celebrate their first birthday at the end of the month. We've just had an explosion of income ETFs because Wall Street realizes there is a demand for this niche. They just gave a 42-cent dividend, which is in line with how much the previous months have gone, actually a slight increase. GPIX paid a 34-cent dividend again, very consistent with previous months. They are also up 26% so far. Until somebody can show me a better fund that gives us a 7.3% plus yield with no NAV erosion, with this much capital appreciation, Goldman Sachs is going to continue to be number 1 on this list. Low expense ratio, opportunities for cash flow. Let me know what you think of my rankings in the comments below. I read all the comments and take them into consideration when making these rankings. Come join other dividend investors who are retiring early on the Discord link below. Leave a like for a small-time creator. I've beaten the stock market that lasts 3+ years. Check out the Patreon link below for all my weekly trades. My videos are found in podcast form under the Collect Cash podcast name, and I will catch you on the next one.
I just keep buying it. And everybody else is like, this thing is reverse split, and I buy 400 share.